At 2:30 p.m. on Tuesday, my phone suddenly began ringing off the hook. My Facebook, Instagram, and news subscriptions all went crazy. Everyone was talking about the same thing. As expected, the Reserve Bank of Australia had just announced a 0.25% interest rate cut. Following the recent Australian federal election, yet another uncertainty has been resolved. As usual, the Reserve Bank also released its economic forecast for the next 12 months. So what's the current state of the Australian economy? Was this rate cut a signal that the economy wasn't doing well? Will there be further cuts? What impact will this have on our daily lives? Especially for those looking to buy a property, it's time to adjust your strategy immediately. There are several key steps you must take now to secure investment returns and achieve long-term asset appreciation. In today's episode, we'll start with the current state of the Australian economy, dive into the more profound logic behind this rate cut, predict future interest rate trends, explore how these changes will affect everyday life, and discuss how property investors should prepare for the market volatility in the next 12 months, positioning themselves as winners in this wave of wealth redistribution. Hi, I'm Alex. I hold a master's degree in accounting and have worked as an accountant. I've been a property investor and a stock investor for years. Then I started my own company, helping hundreds of people invest in the property market to achieve financial freedom and retire early. And you're watching Oz Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. First, let's examine Australia's economic condition now. The Australian Bureau of Statistics just released the employment data for April. The unemployment rate remained steady at 4.1%, unchanged from March. An additional 89,000 new jobs were created in April, passing market expectations. The employment-to-population ratio rose to 64.4%, nearly matching the historic peak of 64.5%. The unemployment rate has been between 3.9% and 4.1% for the past 17 months. Meanwhile, inflation has declined significantly from its peak of 7.2% to just 2.7% as of March. The Australian economy has stabilized, which is great news for households and investors. Traditionally, the Reserve Bank of Australia focuses on achieving two key objectives. One, controlling inflation. The RBA targets a trimmed mean CPI between 2% and 3%, which they've already achieved. Two, maintaining employment stability. The target is achieving full employment. What exactly does full employment mean? The RBA clarified this in their interest rate decision documents from February this year. According to the RBA, full employment is defined as the highest level of employment that the economy can sustain without triggering high inflation or excessive volatility. There isn't a fixed numeric benchmark. Instead, they rely on indicators like the unemployment rate, employment-to-population ratio, labor force participation rate, and wage growth to estimate whether this level is reached. The definition of full employment shifts in response to changes in economic structure, population, and labor conditions. For instance, if the population grows and the labor participation increases, the number representing full employment also rises. So full employment has no fixed numerical standard. It relies entirely on the Reserve Bank's own assessment and judgment. They declare it's achieved when they believe it's achieved. In my opinion, immigration flows into Australia have already slowed. Population growth has moderated, and the unemployment rate remains steady. The employment-to-population ratio is climbing close to historical highs. It appears we're approaching full employment. If this is the case, the RBA has already achieved its goal of stabilizing inflation through previous rate hikes without impacting employment. The Australian economy has thus achieved a soft landing, meaning the next step could be to focus on secondary goals, such as stimulating private sector investment and overall economic growth. The most powerful tool at the Reserve Bank's disposal to achieve this is the interest rate. On Tuesday, the Reserve Bank of Australia decided to cut interest rates by 0.25%. This decision continues the rate-cutting cycle following February's reduction and April's pause. The official cash rate has now declined from its peak of 4.35% down to 3.85%, marking a total drop of 0.5%. So what led the RBA to lower rates again this time? I watched the entire press conference on Tuesday afternoon, along with the subsequent statements released by the Reserve Bank. Here are some key reasons behind the decision. First, inflation within Australia is already under control and has entered the target range of 2 to 3%. Given that inflation has reached its target, it's no longer a strong justification to maintain higher interest rates. Second, uncertainties surrounding international trade and tariffs remain a significant concern. These uncertainties tend to have negative implications for Australia's economy, potentially weakening economic growth, employment, and inflation. Thus, by starting to cut interest rates now, the RBA aims to offset future uncertainties. Should rates be cut again, the reason might shift towards directly addressing emerging economic issues. Alongside its rate decision, the RBA also published its quarterly economic outlook report. This report details the Reserve Bank's forecasts on factors like Australia's future economic trends, inflation, and interest rates. It offers crucial insights into the direction of the RBA's future monetary policy decisions. The report highlights a few key points. Number one, the RBA predicts China's economic slowdown won't be rapid because tariff impacts and economic uncertainties will likely be offset by China's stimulus policies. Number two, international tariffs and related uncertainties will likely cause a moderate slowdown in consumer spending among Australians, but the slowdown won't be severe. Number three, regarding international tariffs issues, the RBA believes these will effectively lower domestic inflation in Australia. This aligns exactly with what I discussed earlier in April during my live stream and episodes right after the US announced the tariff war. Based on these 3 points, the Reserve Bank forecasts that Australia's economic growth will slow down slightly but will still remain positive. Domestic unemployment rates might see a slight uptick this year, and inflation should remain around 2.5%. This is the RBA's forecast for Australia's economic future. Clearly, we're looking at a likely downward trend in interest rates, but when exactly will the next rate cut happen and by how much? Today, Australia's Big Four banks have all updated their forecasts for future RBA rate movements. ANZ predicts rates will drop to 3.35% by August this year. That means another 0.5% cut before August. CBA and Westpac forecast 2 more cuts of 0.25% each by year's end, also bringing rates down to 3.35%. NAB is the most aggressive among the Big Four. They forecast 4 additional rate cuts, July, August, November, and February next year, totaling another 1.25%. This means 3 cuts of 0.25% and 1 of 0.5%. If this scenario materializes, the market will go crazy. So how will the RBA's rate cut affect us? If you have a home loan, rate cuts means lower interest repayments. Typically, interest rate cuts in Australia reduce monthly home loan repayments, especially for those on variable rate loans. When the Reserve Bank lowers rates, other banks and lending institutions generally pass on the full cut to their mortgage products. If fully passed on, home loan interest rates will drop accordingly. For example, with a 0.25% rate cut, a $600,000 mortgage with 25 years remaining would see monthly repayments decreases by about $91. For $500,000 loan, repayments decrease by approximately $76 per month. And for $1 million loan, monthly repayments drop by about $152. However, only variable rate mortgages immediately reflect these cuts. Fixed rate mortgages remain unchanged during their fixed term, typically 1, 3, or 5 years, and borrowers must wait until the fixed term ends to renegotiate loan products and interest rates. Many people believe that when the RBA cuts rates, their variable rate mortgage repayments automatically decrease. That's not always true. Banks operate differently. While most banks reduce variable rates automatically, some delay a lot. It's very important to regularly check your mortgage account and bank policies. If 2 weeks pass after the RBA rate cut and your rate remains unchanged, call your mortgage broker. If your broker isn't responsive, find a new one or just call the bank. Some banks lower your monthly repayment amounts. Others keep repayments unchanged but adjust the ratio between principal and interest, effectively letting you repay more principal. It really depends on your bank. If your cash flow is tight, request a lower repayment amount. If your finances are comfortable, there's no need to adjust. Paying extra principal on your home loan isn't a bad idea. Now you may want to ask, what will this rate cut and future cuts mean for the Australian property market? Since the first rate cut in February, the overall Australian property market immediately reversed from a decline into a growth phase. We've seen growth for 3 consecutive months, February, March, and April. Sydney and Melbourne have followed identical patterns. Melbourne managed to break out from 18 months of declining trends, achieving 3 months of growth, a clear indicator of market strength. Brisbane and Perth previously experienced slowing monthly price growth. Although prices were still rising, momentum was slowing. But since February, this trend reversed. Brisbane recorded 2 months of accelerated growth, and Perth also saw faster price increases by April. Last week's auction clearance rates rose significantly nationwide, from 60.8% at the end of April to 68.8% by mid-May. with auction volumes nearly doubling. Cities such as Sydney, Melbourne, and Brisbane all had improvements. Melbourne's clearance rate surged from 60.5% to 73.8%, approaching a seller's market again. This is exactly why in Aus Property Strategy episode 074, I mentioned that the first wave buying window for early birds is closing. When it comes to buying a property, most people follow other people. Why? Because of uncertainty, lack of information, and confusion. Only a small number of people clearly understand market directions and know precisely when and where to act. Those seasoned property investors have already acquired properties over the past 30 days. Among our Vision members who were ready to buy, nearly all have purchased properties recently, some in their own names, others via family trusts or through self-managed super funds. Why did we recommend buying before the rate cuts? Because the future direction of Australia's property market is already clear, with almost no uncertain factors remaining. The latest rate cut was the final key factor. Property prices fundamentally depend on supply and demand, with multiple underlying factors influencing both sides. On the demand side, it's primarily about people and money. Population growth, immigration, interstate migration, and shrinking household sizes contribute to greater demand. More people naturally means more demand. In terms of money, factors such as real wage growth, parents' assistance, government subsidies, lower interest rates, and easier credit collectively enhance purchasing power. More people plus more money leads to higher demand. On the supply side, decreasing land availability, rising development and construction costs, increasing labor costs, fewer construction workers, and large-scale government infrastructure projects competing for private sector labor, combined with declining productivity in Australia's construction industry, had weakened supply. Now, with interest rates decreasing and likely to decrease further, property prices naturally trend upwards. As previously mentioned in my episodes, even without rapid rate declines, I'm bullish on the Australian property market over the next 2 decades. Lower rates will simply accelerate this outcome. So given Australia's ongoing rate cuts and rising property prices, what should we do next? Some people may feel they've already missed the lowest point of housing prices. If they buy now, wouldn't that mean paying more? Many first-time buyers have this concern. Emotionally, I can completely understand. Perhaps you're thinking, I did want to buy earlier, but my finances weren't ready, and the loan wasn't approved. Or I was simply too busy at work to think about investing. Or maybe I wasn't ready to step out of my comfort zone into something completely new. What if the market were to drop again? After missing the market's lowest point, inexperienced investors often wait, hoping prices will someday return to the previous low before buying. Semi-experienced investors may be waiting for the next market dip. Even if prices don't fall to that earlier low, they'll buy as soon as they see an opportunity. More experienced long-term investors typically don't focus much on whether the market is rising or falling. They simply buy properties suitable to their needs, using tax strategies and wealth planning to minimize long-term holding costs and allow time to beat the market, securing long-term average growth. The more advanced investors approach the market with a long-term perspective. When there's no obvious opportunity, they proceed steadily, buying properties as usual. But as soon as an opportunity emerges, they buy more properties, ultimately outperforming the market average over the long run. At Aus Property Strategy, we use this high-level approach when providing services to our Vision members. If you've invested in stocks before, our strategy is essentially the same to regularly buying ETFs using dollar cost averaging as the foundation of an investment portfolio. When the market presents an opportunity, we grab it by adding high-growth potential assets to hold long-term, further strengthening the portfolio. Perhaps this explanation still seems somewhat abstract. Let me clarify. If you want to buy a home for yourself to live in, just buy it. Timing isn't crucial. After all, you'll live there for 10 to 20 years. Comfort and convenience are your top priorities. If you don't buy at the absolute lowest point, holding long-term, you will still benefit from average market appreciation. But if you're looking to buy an investment property, now isn't the starting line. It's when acceleration begins. The biggest cost right now is time. The longer you wait, the higher your costs become, and they accelerate quickly. If you're buying an established property, it's worth paying a bit more now and securing it, rather than delaying and facing an even higher price tag later. If you're buying a new property, give the developer whatever price they're asking. Don't hesitate. Hesitation could mean waiting for the next stage of release, which always comes with increased prices. Let me conclude by directly addressing those of you who've watched countless property-related videos online but have taken no real action. You certainly agree making money is important, yet you avoid doing things you already know could make you money. Perhaps you're earning a good salary from your 9 to 5 job, have a comfortable life, and after work and on weekends, you go swimming, hit the gym, go shopping, play sports, or go wine tasting. You have time for all these activities, but somehow never have the time to explore property investment seriously. I've met many people in similar situations. Typically, those who've either never experienced significant losses in investments or have never invested at all. Subconsciously, they're afraid to engage with new things. They keep themselves within their comfort zones, avoiding facing their current financial situation, unwilling to immediately tackle retirement or long-term financial issues. They endlessly postpone addressing these critical issues. Some even think property investment is simple. Just buying a property is not complicated at all. If what I've described is you, the core issue is that you haven't yet gone through what I call a financial awakening. It usually happens after a significant setback or loss. Prompting deep reflection, you start embracing new ways of thinking, changing yourself, and taking real action. Our Vision members have already experienced this financial awakening. Some after suffering substantial loss in property investments by buying the wrong properties. Others who trusted us from the start without ever buying a property. All you need to do is simply go to my Facebook or Instagram page and book a 15-minute free consultation with me. Or send me an email for booking. It'll be well worth your time. If you made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. And have a good one. Bye.